If you're new to investing, you've probably heard the terms stocks, ETFs, and index funds. But what's the difference? Today, I'll break it down in the simplest way possible, so you know exactly how each one works. Welcome to Wealth Made Simple. Here, we turn complex financial topics into clear, step-by-step guides. By the end of this video, you'll know which investment might be right for you. Let's start with stocks. When you buy a stock, you're buying a small piece of one company. If the company does well, your stock grows in value. But if it struggles, your investment can drop quickly since it's tied to just that one business. Now let's talk about ETFs, or exchange-traded funds. An ETF is like a basket that holds lots of different stocks inside it. Instead of betting on one company, you're spreading your money across many. ETFs can focus on industries like technology, energy, or healthcare, giving you instant diversification. Finally, index funds. These are similar to ETFs, but they track a specific index like the S&P 500. That means you're automatically investing in the 500 biggest companies in the US with just one purchase. Index funds are popular for beginners because they're simple, low cost, and historically perform well over time. So here's the difference in simple terms. Stocks are a single company, ETFs are a basket of different companies, and index funds track the entire market or a large portion of it. The choice depends on your goals. Stocks can be high risk and high reward. ETFs give you diversification with more control, and index funds are the easiest way to grow wealth steadily over time. Which one sounds best for you? Comment below and let me know. And if you found this helpful, hit like, subscribe, and share this with someone who wants investing explained simply.